This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have another investment guru, another property investment guru, I should say. We've got the co-founders of Create Cashflow here. Well, I say the co-founders because the other one's here in the office, but in our podcast today, we have Shaun Atkins.
Thank you. Thank you for welcoming me in. I'm enjoying the beautiful views of the harbour here that you have.
Thanks for coming in. So Shaun and his business partner, Anthony Dart, have come in from Queensland today to speak to the team about some of their investment opportunities. And we thought we'd take this opportunity to also film a bit of a session about their product offering to our clients. So I say Anthony's here because he's literally probably about 20 minutes away right now working with the team on some attractive scenarios. But I guess let's start with giving a bit of a background about Create Cashflow and yourself. So Shaun and Anthony have been, I guess, in the investment world of purchasing investment properties for investors and clients of ours for over 10 years now.
Yeah, I'd say it's near on 10 years, give or take. Yep, been doing it for a while.
And I guess, so there's been a bit of a changing climate in 10 years, but there's clearly a growing demand. And this is something that we've spoken about in previous podcasts. So some of our listeners are going to say they've heard it all before, but this one's a little bit different with the product offering that we have to discuss today. But there's been a bit of a changing climate with investors in recent years really shifting to other marketplaces. And that's something that's no surprise from our listeners, that we've spoken well and truly about people being a bit tired and burnt out from local investment properties, as in if you're a Sydney sider and you're just buying in a suburb that you're familiar with, generally the yield's not that good. And there's been a growing demand of people looking in other marketplaces, interstate, sometimes regional areas. And the product offering you have here shows investment properties, and I call it a product offering because there's 4 different investment asset classes, and the various asset classes have between 5 to 14% yield. Now, that is something you definitely can't achieve locally that easily.
No, you're not getting a 14% or even a 5% rental yield in Sydney. You're lucky to get 2.5%, 3%.
Yeah, and that's gross too, right? So, yeah. I guess let's start talking about some of these various products. So obviously there's the 2 somewhat cliche investment strategies which previous guests in our podcast have discussed, which is just looking at other marketplaces for an established home or doing a house and land package. They're 2 different avenues. So the established home is somewhat the safest for some of our investors. They like that because they can buy in an established area. If they can just open up a map and see how close it is to a CBD, they get comfort with that. And I say a CBD because it's not a particular CBD that you're looking at. Could be Brisbane, could be Melbourne.
Yeah, it could be Brisbane, Melbourne, Perth. Generally, as you kind of mentioned, we stick clear of Sydney, but we also do the satellite cities of those major areas. So we got Melbourne, we've got the satellite city of of Geelong and Ballarat. Yeah. In Brisbane, we've got the satellite city of Ipswich, and realistically going all the way down to the Gold Coast. That is already packed out, but anywhere between North Brisbane and let's just say Deception Bay, all the way down to the Gold Coast, realistically.
Which covers a big area.
Big area, yeah.
What about I don't want to give too much of your secret ingredients away, but what about other areas along the East Coast? Do you like regional areas like Newcastle?
Newcastle is, you can have good investments in Newcastle. For us, it is a little overpriced for what we're wanting to do for our clients. There's many other areas that you can get better returns and a stronger rental yield. So for us, we concentrate, our main fundamental focus is building someone's portfolio over the long term. Now, in order to do that, the old saying is you can't have a high rental yield and high growth. You surely can. And, some of these are good examples as to why you can do that. But, we look for areas where the entry price is going to have the most amount of growth. And as you would know, with the policies that are coming in at the moment on the 1st of this coming month, October, of the first homeowners grant, it's only going to make these sub 1.5 mil prices just skyrocket. And anything sub 1 to 1.1 is going to see some astronomical growth. Where Newcastle, you're really already looking for an old style property at like 1.3.
So what's your sweet spot? Is it that 1 to 1.5? Is that what you would say is your preference for an investor that comes to you to looking for an investment property?
I would say our sweet spot it depends on the area, but generally our sweet spot for a standard established property, we're probably looking at 850 to 950 is a sweet spot. Once again, we're looking at areas of gentrification. So we look at the suburbs beside it. What are they doing? Are there opportunities for people that are getting priced out of that to go into there? Because once again, we want that capital growth to be able to pull out that equity to go again for the next one.
So that's a nice concept, right? And so let's break down what an area looking like gentrification actually looks like, right? So you just called out something. If a neighboring suburb is quite expensive,
yes,
is that what you're saying?
Yep.
Then naturally there'll be a flow-on effect. Any other data behind that?
There's lots of different data points. So I think I'll use the example that I used before, Gold Coast and Brisbane.
Mm-hmm. Population growth is a data point there.
You got population growth, you got amenities growth. You start looking at, okay, well, are there new state schools going in there? What's the infrastructure like? Are they upgrading the on-ramps and off-ramps of the highway? If they're doing that, they are predicting more people coming into that area.
So let's call out, sorry to interrupt you there,
no.
But let's call out a couple of things on that note, because everyone's going to say, well, there's population growth everywhere. Well, Brisbane has the highest population growth by a percentage in Australia.
Yes.
It has had the highest for 10 years, and it's still forecasted, I should say, to have the highest population growth in the next 10 years. On top of that, we've also got record amounts of government spend on infrastructure for the upcoming Olympics.
Yep, exactly right.
So tick on those data points.
There's a lot of ticks. And to also note, I read something the other day that the Gold Coast is now the most overpopulated. They don't call it a city. Gold Coast is apparently still classed as rural, like you tell the locals there. Gold Coast is still rural, but the Gold Coast has been just labelled the most overpopulated area in Australia.
Yeah, well, it's crazy that, once again, forgive the listeners that are listening to these podcasts all the time and hearing some same messaging, but it's because it's fact. I can't believe how many high-density sort of unit developments have gone up in the Gold Coast, and we still have continued growth. I would have thought 5 years ago there was a supply issue and there's just too many units being supplied to the Gold Coast area, but there's demand that meets this ridiculous amount of supply. It's a mixture of people relocating for affordability reasons, people buying for a second home, especially people from Melbourne, because they want to try and get some blue skies and nice weather. And demand, I mean, supply just can't keep up with demand, really.
No, it's very true. Although those things you mentioned, but now I think the general population and the mum and dad investor are stepping away if you need to buy your own or occupy a home, and very much realizing, thanks to things like this, that it is much more cost effective for you to rent where you live and to buy an investment somewhere else. So that's where you start getting these shortfalls in property availability, because people are renting on the Gold Coast, like myself. Me, my wife, and my family, we rent, and we buy in other areas.
So that's what we call the rent vesting strategy that we've spoken about.
Rent vesting.
A lot of times in this podcast as well, which is blowing up at the moment. And I should call out on that note that, it's such a growing trend, and some lenders are specializing in this, I guess, rent vesting strategy with buyers agents like yourself buying multiple investment properties for people wanting to build a portfolio by doing it in trusts. And the strategy behind that is, if you buy in a trust, some lenders will then ignore the debt when you buy another property in a separate trust. And Macquarie Bank came out recently saying they've got 40% of new lending volumes of July and August, I believe it was. 40% of all new lending in that period was via Macquarie, and it's because of that policy that people.
Well, they have the best the best policy around trust purchases because they don't need it to be neutrally geared either. Most lenders need it to be neutral or positively geared.
Yeah.
Macquarie's just like, well, the security's not with us. Negative, I don't care. Ignore it.
And the truth is, if you're self-employed, you can offset that loss by putting company profits into the trust.
Yeah, exactly right.
So there's ways that you can take advantage of that negative gearing. So some lenders have concerns about negative gearing in a loss being sort of hived off in that trust, and you can't actually take it against your personal name. But there's ways to get around that from an accounting point of view. So point is, growing space, growing demand, investors now getting a little bit more sophisticated in their investment approach and buying in trusts, and then maintaining their borrowing power for multiple acquisitions and multiple investments. But you've got to do each in a standalone sort of SPV as such.
Yeah.
So let's bring it back to these four investment sectors. So we've got established dwellings. That's the bread and butter for investors. Low risk areas that are established and
blue chip properties effectively.
Blue chip. Yeah. Still an attractive return, 6% on average, and your estimated value increase about $100,000 in the first 12 months.
Yeah.
Then we move on to...
That's taking away that fun COVID period everyone likes to talk about as well, I think.
Yeah.
Anyone who's probably watching this probably gets smashed with buyer's agents and they're like, oh, it went up by 150 grand in 2 months. So when we do our data and our references of growth, we exclude that super hyper growth period of 2 to 2.5 years because you could throw a pin at a dartboard and make 100 grand.
Which was also off the back of emergency interest rates, right? So that was unsustained growth. And we don't actually want the property market growing that aggressively. It's not healthy.
No, well, it's not good for investors either because they get tapped out and then, the average investor who just wants a couple, they're gone.
And also the rent can't keep up with that price growth, as in the yields diminish because inflation on rent isn't the same as the price growth was on the asset.
Yeah.
Anyway, so then we'll move on to the second class. The second type of investment class, that is brand new sort of house and land packages. And what we were talking about with the team earlier today is this is once again on the outskirts of CBD areas like Brisbane and Melbourne. You said sort of Ipswich or whereabouts?
Yeah, so we're talking about places like if you're in Brisbane, we're kind of talking about Logan Reserve. So there's a couple of new estates there. In general, in Brisbane, we'd probably go as far as Lowood. If you know those areas, we're not talking, first and foremost, we don't purchase rural.
Yeah.
If you can't get in your car and drive to the city or that satellite city, it's too far from us.
Yeah, so let's talk about that because we know we've been dealing with investor-focused buyers agents like yourself for a long time, and we've been seeing people buy in these areas for about a decade, I'd say, right? So Logan and Ipswich, they're established areas. They're not new areas. People have been buying investments there for a long time, and there's been sustained growth.
Yeah, exactly right. And it's because it reaches those points of in between Gold Coast, in between Brisbane, two very major populated cities that are slowly growing, and it was already built out. So as prices grow, people are naturally going to have to move somewhere else. So they don't want to go inland. They don't want to go south past Tweed, further from Brisbane. They don't want to go north past, the city. So that's the only place that they have to go. So if you ask anyone that knows the Gold Coast, no one would think, oh, I don't want to live in Coomera. And then it's like, I don't want to live in Pimpamar. And then it's, I don't want to live in, Helensvale. And then it just keeps going and going. And now, smack bang in the middle, you got areas like Eagleby and Logan are $1 million homes.
So before we talk about what that looks like in the process of buying a house and land package in the outskirts of Brisbane, outskirts being, I think that's about 40 kilometres out of the CBD.
Yeah, maximum.
Yep. Let's talk about favourite areas and your secret sauce and that you might be spilling here on Melbourne. Yeah.
In relation to where we're looking or the kind of properties?
The house and land, where are the sort of preferred house and land packages in Melbourne?
Yeah, okay.
Because I understand that the Melbourne perimeter is all around. So there's a lot more house and land package supply there.
There is a lot more land and supply packages in Melbourne. You're correct. So we go to, so you got the city, you got Melton, on one side. And then, as you're following that chain all the way up, you've kind of got like, Caroline Springs, which is technically what you would call the last fully built out established area.
Forgive my ignorance. What direction are we?
We're talking south as we're going to Geelong or to Ballarat.
Okay.
Yeah, so on the west side of the city.
Southwest.
Yeah, so southwest. So generally that southwest region, once you go past, I guess, Hoppers Crossing, and once you go past, you got like Caroline Springs.
Yeah.
Those two direct lines there have two direct lines to the train station. Two direct train lines to the city.
Yeah.
You can drive there in 30, 35 minutes. You can get on a train and be in the city within relatively about the same time, which isn't uncommon for the average person living in the city to drive over an hour. Like my sister lives in Welford, and that almost near Geelong, and they live and work in the city.
Yeah. So tell me, what are we kilometres from the CBD there? About the same, 30, 40?
We're probably around about 30-ish.
30.
So then we start looking and going a little bit further out to maybe around that 40. That's where we really want to start making sure we're very close to a train station.
Yeah.
But then once we start looking at that, then we've got that Melton CBD and Werribee area as well.
Gotcha.
So they've got their own little, I guess it's like here in North Sydney. You've got the city, but then you've got a little business, a smaller business district here where you guys are.
Yeah.
Where obviously that's much closer to the city than these are.
Yeah, I understand.
But they've got their own business districts there which support their own diversified economy. So anywhere in between that, you can get that. That's a longer term gentrification.
Yeah.
But you can pick up brand new houses there for $600,000.
Perfect segue into my next question. So $600,000 for a house and land?
For house and land, yeah.
So what's the land?
We ideally don't like to get anything under 300. So we're looking at about 300 to 350 square meters.
And how much is the land itself?
Probably around, if we're talking, like, I just give away suburbs. Like if anyone calls us, we tell them anyway.
Yeah.
We don't try and hide secret herbs and spices.
But price-wise?
Price-wise, we're probably looking at about 350 on the lower end.
So you can put a house on it for 250.
You can put a house on that for around 300.
Wow.
Yeah.
Wow. That's attractive.
Yeah.
And then this is the type of investment that you could easily get 5% on.
This is the type of investment you can get 5% on. Yes.
Yeah.
Yeah.
So 650 on sort of, let's say 30 kilometres away or half an hour away from Melbourne CBD. That's down.
You're talking 3-bedroom, 2 bathrooms on that one
for 350.
Yeah.
You will help find the builder. You will project manage it.
Yeah, we find the block. We already know who the builders are. We only work with a very small amount of builders because they've been around for a long time.
So you take all that away from the investor?
We do absolutely everything. We project manage it as much as we do project management. And then every fortnight, month, we're updating the client, letting them know how it's going. So realistically, the client can just rock up, say, yeah, I want that, and then they don't have to do anything.
But you've got a bit of a repeat formula here, which you just keep.
Yes.
So these builders you've got some rapport with.
Yeah.
It's a pretty easy process for you to manage and with little sort of input from the investor or client, right?
Yeah, exactly right. So as soon as we present them an opportunity, we've already gone through and utilized that build process, and the property itself, we've made sure it's fit for investors. We give them a couple different variations of facades and internals that we know is good for investing and is cost effective.
Yeah.
And then they can just say, I want the autumn theme, whatever it may be.
So let's move on because we haven't got to the two favorite ones. But before we move on to the two favorite ones, Brisbane house and land. What do we need?
Brisbane house and land. We're probably, if we're on the outer skirts, we're probably looking at 800, probably the cheapest. But then we can be looking all the way up to 800 to $1 million for a nice freestanding 4-bedroom, 2-bathroom home on a fairly decent block for those prices.
350 squares?
No, these ones we get a little bit bigger.
Okay.
So I think the last one we did with one of your brokers was about 650 square meters, and that was about 900 and it was low nines. Yeah.
So a bit more expensive, but same yield, 5%?
A little bit more expensive, same yields. And I think it's more fit for Queenslanders don't really live the same, and that's knowing your market. Queenslanders don't live the same as Melbourneites.
They want the bigger.
They want the bigger area. They don't want to, affect. They don't want to feel like sardines. Where they're used to that.
Yeah,
Melbourne's used to it.
Melbourne's more city living.
Melbourne is definitely more city living, 100%. Yeah.
All right, so now let's move on to the more interesting type of investments.
The fun one.
The fun ones, which we'll call a bit spicy, but I don't want the word spicy to be a deterrent. But so the two different classes there are dual occupancy and co-living. So let's start with dual occupancy. Dual occupancy, for those people that don't know, what is it?
So effectively, it's very similar to what some states or some people call a duplex. A little bit different though. So the houses are connected like a normal duplex. Generally, they're single story. Ideally, we like to get a 5-bed, 3-bathroom. But what that effectively means is the house is almost cut in half. They got a nice firewall in the middle. 2 separate driveways, ideally, most of the time. And one side of that home is 3-bedroom, 2-bathroom. The other one might be 2-bedroom, 1-bathroom. And you rent them out individually.
2 separate leases.
2 separate leases. It's on the one title. There's no strata.
2 separate kitchens?
Yeah, so it's 2 homes.
2 homes.
It's 2 homes.
Yep.
2 homes, 2 dwellings. They've got a joint firewall, their own driveways, their own entryways. That's it.
So do you find established dual occupancy, or is this also something that you find and build?
We do both.
Okay.
So it depends on the particular client's needs and what's going to get them to that next property.
Yep.
But we can find dual occs, established and new builds. Generally speaking, in the Queens, they're not as popular or known in Victoria. They're only starting to happen there. So dual occupancies are really just reserved for Queensland. Not many other areas do them that much.
So going back to some of the areas that you mentioned in Brisbane then, are the dual occ generally closer to the city?
Dual occs are genuinely closer to the city.
Yeah.
We do purchase them scattered around like areas like Deakin and stuff like that if you want to have a Google of where that is.
Yeah.
But these ones we try to get a little bit closer to the city and to schools as well. A lot of the time it's like a family.
Yeah.
A younger family who might rent this, they're both working, or you might have a single mum living in the 2-bedroom, 1-bathroom one. But yeah, generally speaking for these, you want to be closer to amenities because the kind of person that rents these, they value convenience and they don't want to be traveling out in and out.
So I imagine, just to summarize that type of asset and investment, it's sort of like a mix between a house and an apartment. Let's call it more like townhouse style living.
Yeah.
And it's for markets where there's probably mainly houses, right? And so it's providing a strata type tenancy for an area that doesn't have units, let's say.
Yeah, it's an affordable rental opportunity in areas where the other comparative is hundreds of dollars of more a week.
Yeah,
and you want to live in that area, and they work really well for owner and for tenant.
So it's giving the tenant a more affordable solution in markets where there is no other solution.
Yeah, exactly right. Because often they're hundreds of dollars less.
Okay, so hundreds of dollars per week. I'm assuming. Right?
Yeah, that's the one.
So that's 7%.
Yep. We're looking at around 7% rental yields for that.
Quite easily achieved?
Very easily achieved, yeah. We can get around 7%.
Now the spiciest, my favourite. So this is the one that we went through with the team today. We had a great team meeting, more engagement than I've seen in a team meeting than most. I think some of our brokers were looking at this personally, actually.
Yeah. A couple have had a chat.
Yeah. So co-living, which is an interesting one.
Yeah.
To start off, what makes it spicy is the 8 to 14% return. Which is hard to find. 18 to 14%. I mean, 8 to 14%.
18.
Yeah. 8 to 14% rental yield, that is. So it's kind of like dual lock, but a bit more on steroids.
It's dual lock on steroids. Yeah.
Where it's basically a modern day boarding house, but how many rooms is subject to the area, I guess. So why don't you explain a bit more about co-living?
So effectively co-living, as you kind of said, it's a hybrid version. Now they're not a new thought process.
No,
They've been doing it. We've been doing it for a very long time here in Australia, and also in the UK, they've been doing this for donkey's years. Now over there, they're called HMOs, but they're a little bit more basic version.
So it's kind of catering toward the same demand as dual lock. So let's say areas where there's a lack of, let's say, one-bedroom units, lack of affordable homes and housing for tenants. You've got young professionals that want to just rent a room, that want to rent a 2 or 3 bedroom house or apartment, and there is no 1-bedroom homes or apartments in that area.
No. So
you essentially buy a house. It could be established, or you could actually be the one building the house.
Yep. So ideally we build them. So Anthony, my business partner here, who you mentioned before, he's done 3 conversions on these for his own homes, and he's converted them into co-living. But
preference is to build them.
Preference is to build them because you can get purpose-built co-livings and they're much better. Yep. But from the street, just to explain what they look like, from the street they look like a normal 3-bedroom, 2-bathroom home. If you're in Brisbane and Melbourne, you've probably driven past 1 million of them and not even realised. But internally, they're anywhere from 5 all the way up to 9 fully self-contained apartments.
So people don't... people listening to this online via Apple or Spotify or whatnot, wherever you listen to your podcast, won't be able to see the floor plans in front of us here that we're looking at. But you can go onto the Create Cashflow website to inquire and get a copy of these floor plans to understand these co-living sort of configurations. But if we look at an entry-level one could just be a house that's got 1 kitchen, and it's just it's like a shared house between 5 bedrooms, right?
Yep.
And it's got 5 separate leases with each individual in each bedroom.
Yep. Exactly
and
right.
When it comes to borrowing the money from the bank, you present the 5 leases. That's if it's a refinance, let's say. Up front, you can just give an appraisal letter on that.
Yep.
Yep. So to your point, you could drive past it and it wouldn't look any different to a normal house because it effectively is just a normal house.
Yeah.
Just with
a few more people in it.
Yeah, just
a few more strangers living in them.
Split tenancy.
Yeah.
Now to do that, I think we touched on this morning in our team meeting, there needs to be a certain zoning.
Yeah. So these council zonings, they need to be approved, but the house itself has to get what's called a 1B certification,
which is not that hard to achieve.
No, it's not that hard to achieve. So the council or an independent body for the council effectively comes off, has a look at the home, make sure it's got its smoke alarms, make sure it's got its exit signs, fire evacuation plan, all those other kind of just basic things, bigger insulation, and they sign it off saying, yep, this is now available to be individually leased to 3 or more. A normal home on a 1A can only have 3 individual leases. This allows for 4 or more.
Now, I'm going to guess that you can help project manage that as well.
Yeah, we do the whole thing.
Yeah.
Great.
So council approval is not the issue. Let's move on so that's the entry-level one.
Yep.
Here I can see 8.9%. Is that right?
Yep. So that's one of our Brisbane ones, 8.9% rental yield.
Yep. So then naturally more bedrooms, higher yield, right?
No, this is still only a 5-bedroom one.
Yeah, but what I'm saying is,
more bedrooms.
As we increase from that point, because that's a 5-bedroom. As we increase, the yield just naturally increases.
Exactly right. 5, you're looking at 9%. You can even look higher depending on where we're doing it. You can look at a 9 or a 10% yield on a 5R in Melbourne.
So let's look at this. The
9er. The Big Bertha.
The Hoppers Crossing, the 9-bed, which is really more of a boarding house. And there is a demand for boarding houses everywhere, guys. And how this floor plan basically looks for our online listeners, it's a single-story flat house just with 9 bedrooms that effectively all have their own kitchenette and bathroom.
Yep, that's pretty much it. So we rent them out furnished.
9 separate leases, all 12-month leases.
All 12-month leases. As you said, they got their own en-suites, their kitchenettes. Each room, no matter what kind of one we get, they've got their own private fire door and they have their thumbprint. So they're the only ones that can enter it. It's not like a normal door. And they still have a fully fledged kitchen that they can utilize if they would like to, but they can be self-sufficient in their room.
Oh, there's a separate kitchen. Yes. Okay.
So there's a self-sufficient communal kitchen and laundry
Okay.
if they would like to use that
Gotcha.
kitchen, but they can be self-sufficient in their own.
Now that one was a 1.3 purchase price, and we
Yes.
saw a 12.8% yield.
Yes.
You're not getting that in your apartment in Bondi. That's for
No,
sure.
I believe that one there, after all expenses, including the loan repayments at 80% on give or take about 7.5% interest rate.
Yeah. That's a
Um,
high rate.
Commercial rate.
Oh, commercial loan because it's like a boarding
Commercial
house.
loan for this one.
Yeah.
After all expenses, paying for a cleaner, a gardener, you name it, it was on there. I think this particular client was cash flow positive after tax, and the tax man took their little bit by I think around about $45,000 annually.
Wow.
Yeah.
And you said a 20% deposit.
20% deposit.
So let's talk about something you just touched on. A slightly different management approach to this. So for co-living, you're not splitting the power bill, between 5 and 9 bedrooms, right?
No, you can if you want, but it just becomes really tricky. You got to put split meters in each room, but you choose not to because it's a waste of time.
So, but once again, your lovely team will help with the management of all this, right?
Yep, perfect.
So you've got a recommended expert property manager in most of these marketplaces.
Yep.
Only difference between a normal sort of, let's say, single dwelling house on a long-term lease is the split of shared services like power and water, gas, and insurance is slightly high, which the landlord wears. Sorry, I should say you're not splitting it, you're wearing it. The shared services.
So all the electricity, water, internet, everything, the landlord pays
generally.
But that not all the time. For our clients, we recommend it 100% of the time.
Okay.
These do have solar on them as well, so that wears up a lot of those costs.
Yeah. So if you purpose built this for that purpose,
you're putting solar on them with
solar, and probably now with these new battery rebates, get a battery too. So.
Yeah, exactly right. But that 45 cash flow positive was inclusive of all those shared costs.
Great.
So for every single dollar and cent that you would ever spend on this particular one, it was still 45 grand after tax.
So let's just call out those dollars and cents though. So power and water and gas and whatnot.
Water, internet,
and just cleaning.
And cleaning. Yep. Cleaning of the communal areas.
That's
and
a
gardener.
That's about it.
Yep.
And just on the insurance comment that we covered this morning in the team meeting, just slightly different insurance policy, but
they are a little bit more expensive, but we'll sort out the insurances for you.
Yeah.
Once again, that's also incled in the expenses. Yep.
Yeah. Okay, very interesting.
Property management fees, I would note, if people have heard of these, a lot of people are quoting some ridiculous prices of like 10 to 11% property management, but we work with some really great property managers, and through negotiation, we're getting your normal standard rate for property management. So depending on what areas, it could be like 6.5%, 6%.
Yeah.
So, they're not as astronomical as what some people are trying to charge.
Yeah.
But for our clients, we make sure that they're not paying that.
So I'm going to be the pessimist on the other end of this podcast, where some of our listeners, I'm sure, are asking questions. Like,
of course.
All right, how much demand is there for this co-living? Where are you buying these? What happens if the demand changes? Let's talk about all that. So there seems to be a demand in all these cities. Right?
Yeah. So we do hundreds of these. I'm once again building another one now in Melbourne. So I think that's one thing. We practice what we preach. Anthony, I'll say it's in a suburb called Deanside next to Caroline Springs.
Yeah.
And I'm looking to do another one at the moment. I'm pretty sure I'm stressing your buyer's agent out there that we're using, saying, and another one. And she's like, just slow down a second. I'm like, figure it out.
So there's an ongoing demand because it's an affordable housing solution, really.
It's an affordable housing solution for these examples. So let's talk about, West Melbourne. So we're talking about Deanside, Werribee, Hoppers Crossing, pretty much everywhere in the west between those two channels we spoke about before. A room, all expenses, fully furnished, is going to cost you anywhere between $270 for the ones that don't have the kitchenette in it, all the way up to $350 for the ones that do.
And there is no alternative for $350 like that in the marketplace, right?
That's all expenses. They get their internet, it gets furnished, they have no electricity, no water, that's it.
So you're solving a housing crisis.
And I think that's the best thing about it is everybody wins. The tenant gets a nice, safe space to live.
Yeah.
That's, new. They don't have to worry. They just bring their bag.
Yeah.
That's it. Bag and their clothes. And the landlord gets to, reap the rewards of building something that's needed.
Now you've got a bit of a track record on doing this. You've got some experience. This isn't like a short-lived strategy. You've been executing this strategy for a long time.
Yes.
So I'd love to know, you're saying, based on our conversation offline earlier, you've just mentioned parts of West Melbourne, but there's plenty of parts in Brisbane as well. Parts
of Brisbane. There's lots of places in Brisbane, north, south, Acacia Ridge, Northwood, Northgate, Chermside, all around Brisbane. If you live in Acacia Ridge or anywhere in the north, there's hundreds and there's 1BU registers there. There's hundreds and hundreds of them in Brisbane, and they are all 100% tenanted.
So if you've been doing this for a long time in those marketplaces, how is occupancy rates? How is, let's say, in this 9-bedroom example, which is like nine studios almost, your investors, you were sort of proudly saying earlier, are repeat investors buying more of these investment properties. So clearly they must be maintaining a solid occupancy rate.
Yeah. So on average, it's a 100% occupancy rate. Obviously, we have times where people move out and you need to get somebody in. Generally, that can take 2 or 3 weeks, just like any other normal lease that starts and finished. But we don't have a period of time where we just can't get a tenant. And that's a lot of it is, now some people do. There are some bad stories of these. One, because they haven't built them right.
Yeah.
But the most majority is they've purchased them just in the wrong areas. These aren't for everyone to buy, but they also can't be built everywhere. You need to be very specific. You need to be much closer to the CBDs. You need to be walking distance to train stations, shopping centres like a Westfield. You can't just be putting this in like the middle of some suburb somewhere. It just won't work.
And that's why there's a bit of research and sort of sort of strategic thinking that goes into your purchasing decisions, right?
Yeah.
So on that note, let's call it worst case scenario. If someone buys a property and in 5 years, that 2 of the rooms aren't rented and they get a bit tired of having a 9-bedroom, let's call it, boarding house, or the other ones are just the co-living house that's a normal house. The normal house can just be rented onto a normal contract for a whole family.
Well, you can just rent it. Yeah. But even that, we haven't had anyone that's had to do that. But even in the worst case scenario, let's just say you can't do it.
Worst case.
Worst case scenario, oh my gosh, I can only rent out 3 of the 5 rooms. You're still getting a higher rental yield than you would if you just put a family in that.
And if you wanted to then convert it, let's say the house that's got the 5 rooms and 1 kitchen, you don't need to do any form of conversion to make it a house if you wanted to sell it.
No.
But in the 9-bedroom example, at 13% thereabouts return, in 5 or 6 years, it's just an internal renovation to convert it to a house.
Well, if you wanted to convert it to a house, you could just take out some of the walls, make a media room, whatever you want to do, open up some rooms.
Yeah. But you haven't had to do it anyway.
You haven't had to do it anyway.
Yeah.
No, we've never had that. You're going to sell it at a much higher price and the bank valuations come in much higher.
Yeah.
It's effectively like a mini unit block.
All right. So in all these different scenarios, dual lock, co-living, and the various forms of co-living that you can help, the one call out here is that Shaun and Anthony at Create Cashflow can help project manage the whole thing. Now, I want to touch on something else we spoke about this morning, but without naming the operators out there, this space, there is a lot of buyers agents operating this space. There is a lot of opportunity in this space. That's why there's a lot of buyers agents in this space. What I mean by a lot of opportunity, a lot of investors and that are able to find attractive investments, and there's a lot of demand for this type of product. So we've seen a real rising surge in investors targeting this type of investment property, which we've spoken about in previous podcasts, and even had the likes of Momentum Media sharing their thoughts and all that. The one thing that we need to call out is that some people aren't acting above board.
Yes.
And
A few snakes in the grass, as you may say.
a few snakes in the grass. And let's, like I said, won't name names, but what should you be careful for in this space? So one thing we touched on is people employing their own builders and then charging a bit more for the build.
Yeah, I think if you're going to be doing it, ask who the builders are. If they won't tell you the builders, it's either one or two things. It's their own building company, where they're going to add a hell of a lot of cream onto that job.
So they take margin on the building margin.
Yeah, and they charge you as a client, so they're double dipping there. And the other thing is, if they're not willing to tell you who the builders are, it may mean that they're using builders that don't have a great name. Now, for us, we're very open and proud to say who our builders are across all different kind of platforms. If a client calls us and asks, we're like, this is the name, that's the name.
And let's put numbers on what that could look like if you got that wrong and you went with one of those buyer's agents recommending a building company that they have an interest in.
Yeah.
It could make I'm going to guess, a $400,000 build more like $550.
It can easily add on north of $100,000 to $150,000 onto the build price, sometimes if not more.
So at least 20% sometimes.
At least 20% sometimes, yeah. And then they possibly could charge you project management fees for that build. So they're getting you on as a client, and then they're charging you project management fees to manage their own building company.
Great segue into then fees. All right. So a lot of the buyers agents out there are charging a fee for finding the investment property and then a fee for managing the construction. I've seen fees as significant as $40,000 or $50,000 for a $700,000 investment property all up with the construction.
It's a big chunk.
Yeah, which is quite ridiculous. If you take a year or two of growth just to try and get your fee back. So love your fee structure. Let's talk about it.
So for every property that we purchase for you, whether it's your first, second, third, fourth, to start the process and to start working with, you guys, it's an initial $5,000 plus GST engagement fee, which is fully refundable pending finance. So if you guys here can't get us finance, the client just gives us the money back. The client gives us the bank details, we give them the money back.
You give them the money back.
Yeah.
So no win, no loss type approach.
Yeah, pretty much. Once we find that property for them, let's just say it's an established property on unconditional of that property. So uncon finance, building and pest inspections been passed. A further $10,000 plus GST is due. So $15,000 plus GST with the 5 and the 10. That's for an established.
15 grand flat fee. That seems quite fair and reasonable, and quite actually cheap in my opinion for some of the other fees we're seeing in the marketplace. What I also like about a flat fee model versus a percentage is that obviously you're not going to be incentivized to pay a bigger price.
Yeah, well, the clients know what they're getting into, and it helps us, as I said the first time they come on board, we set up a strategy for them. So we know exactly to the dollar and cent how much money they have to build out that strategy. So, we know exactly where those funds are going. And then, obviously to the contrary, if we do that, a new build property for them, that initial $5,000 plus GST fee that they've paid us, if we decide to do a new build or if they agree they want to do a new build, we give that money to the builder that forms part of their build deposit, which effectively makes our services for free. Us, as well as every single other buyer's agent's company out there, no matter who they are or whether they say they do or they don't, we get paid effectively a finder's fee from the builders. So we don't charge our client and get a fee from the builder. It's all about transparency, I think.
Yeah, love that. So something else I love about your process is that you'll recommend one investment opportunity to one investor. You only put investment opportunities in front of people that you'd execute yourself. You don't rush that process. So some of our clients have felt rushed with other investor agents in the past. They have sometimes a window of opportunity that you need to make a decision. There's no set time frame where the investor has to execute on, right?
Yeah, no set time frame. We generally say that from the time of getting your pre-approval, it's around about 4 to 8 weeks before we're signing contracts for something. Generally, it's around 4 to 5, but if you don't like it, that's fine.
So let's talk about who this is suitable for, just to, I guess, wrap up this type of this podcast today. savings, anyone with 100 to 200 grand in savings?
Realistically, we can work with anyone. Ideally, it's 100 minimum.
Yeah.
If you do have a little less than that, but you've got a strong income and we know we can do something with it, but ideally 100's minimum. If you're a first home buyer, we don't do them too often, but we can work with about 70, but ideally 100 is minimum savings.
Because you want to be at 80%, that's the goal?
Because we want to be at 80%, because we want to extract equity out as soon as we can. Otherwise, we have to go to 80 and then growth from there.
To reverse engineer that, you're saying that your entry-level investments start around 650, so you really want around 130 grand plus stamp.
Yeah, correct. Yeah.
Now, let's also call out that savings could be equity, like you just touched on. So you might have a home and you might have 150, 200 grand in the offset against your home, but you should keep that offset buffer and use equity in the home.
Yes.
If you don't have 150 grand, let's say, in equity in the home, but you have 150 grand or when I say in equity, within 80%, but you have 150 grand in the offset account, you can simply just reduce your loan balance and debt recycle to do a cash out loan. Whole purpose of that is to decrease your non-deductible debt and increase your deductible debt.
You've done this before.
This is general advice, and speak to your accountant to make sure it's specific. Let's now also talk about another type of investor suited to this. It's not just the mum and dad using home, but SMSFs. You're doing a lot of people using their SMSFs to
Yeah, exactly right. SMSFs are for us, obviously, we think SMSF property purchases are a very lucrative form of investment through the SMSF.
A lucrative form of wealth creation with your superannuation funds.
Yeah, exactly right. Like, for instance, I did the math on it not that long ago. If you put in 150, I think it was, into a property of around about that $650,000 purchase price. 80% over that 20-year period, that 150 within your SMSF, give or take your average 7 to 7.5% growth, you're probably looking in 20 years' time, that's going to be worth maybe $650,000 in the SMSF, in the industry super fund.
You're preaching to the choir here because this is very similar content we run on our webinars and seminars. And the key with that strategy, the key success factor is the power of leverage, or the key success reason is the power of leverage, right? So to your point, you're gearing those funds in your super to 80%. You would never gear those funds into an equities portfolio at 80%.
No.
And then on top of that, especially with some of these investment sort of products, you're getting a healthy return that's covering the interest even at 80%. Even with an SMSF loan having a slightly higher rate. So great way to plan for retirement. Love it.
Well, the rent from it's tax-free as well. Once you reach retirement.
And it's CGT, capital gains tax-free.
So capital gains tax-free. If you don't need the cash, you can keep it and have the rent coming through. You don't get taxed on it. There's lots of benefits.
And also in 10 years, let's say you're buying something like this in your 40s and in your 50s, it's appreciated in value significantly, which you witness all the time. Quite quickly, we're seeing with clients that we sort of mutually work on, because as soon as something starts returning 8 to 14% with this co-living or dual sort of type product, straight away the valuation increases, right? So there's instant uplift. So let's say you hang on to it for 10 years, you buy it in your 40s, and in your 50s, it's more than doubled in value. There is an issue with SMSF type borrowing where you can't use the equity to go again. They can just crystallize that, sell it, and go get two new ones.
Exactly. Realize the profits and then go get more if you'd like. And
realizing the gains pre-retirement is not an issue in the SMSF. It's just 2/3, think 10% is capital gains as opposed to the 15% you pay. As in 15% income tax in super. So fantastic. So guys, you can reach out to us for a connection, or you can go straight to Create Cashflow's website. Shaun, anything else that I want to call out about your services before we wrap up today?
Ask questions, get answers to those questions. If people can't answer the questions, they're being a little bit sneaky, or they don't know them. There's a reason. Ask questions, expect answers. That's it.
All right. Well, thanks for flying down and joining the team today and jumping on our podcast, and look forward to achieving some great outcomes from our clients together.
Yeah, thank you for having me.
Thanks, Shaun. Thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcast. This business is built on word of mouth, so please refer us to all your friends and family. They just want to stay tuned to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast.